You're welcome to the Economy and Politics Conversation. I'm Otu Abase. This edition will discuss 2025 monetary policy options in stabilizing Nigeria's economy. Dr. Tilewa Adebajo, an economist and CEO of CFG Advisory, joins us virtually for this session. Let me begin by asking for your perspective on what we can describe as the current global tariff tensions and their implications for the Nigerian economy and monetary policy environment. I believe, of course, you're following the trends of developments between the US, Canada, Mexico, and even the EU and China, the whole global tariff tensions.
Well, unfortunately, these tariffs don't concern us because we don't really export much to the United States, as you know. The United States does not buy as much oil from us as they used to, and maybe they're buying some. And so if you take a look at the breakdown of our exports to the United States, the numbers are very insignificant. African countries have not been a target of the tariffs. And again, the tariffs are specific to American production, not goods coming from China or any other part of the world to Nigeria. So Nigeria and China or any other country still have their normal trade relations. So that doesn't really have anything to do with us. It has to do with the United States and the other countries. However, what concerns us, which a lot of people are not talking about, is the AGOA, which is the African Growth Opportunities Act, which the American government put in place to be able to help African countries to export to America. 32 African countries are currently benefiting from this, but a lot of them are we're not taking advantage of this window. And that window, the Congress recently extended it to expire in 2025. So the danger is that for the countries that have this opportunity, who are using it, Donald Trump might decide not to renew this at the end of this year. And that might be a problem for those African countries that are taking advantage of AGOA. There's a clear directive that it's going to expire this year, and there's a chance that Donald Trump might not agree to renew it. So that's really where we have the challenge, not with these tariffs.
Doctor, what you just said brings memories. I mean, the Africa Growth Opportunity that came up the period of Democratic President William Jefferson Clinton, and even George Bush, who was Republican, that took over, sustained that. So it's very clear you've brought that fresh memory of the AGOA. And that's something that I believe the Trade Ministry and Africa would look at, even as we're in the era of the Africa Continental Free Trade area, and how that will really shape the continent. But very, very clear insights from you. Let's get back home as we look at the recent Central Bank of Nigeria hosted a monetary policy forum discussing managing the disinflation process. And from here, I mean, looking at the current state of the economy, what should be the priority for monetary policy authorities to achieve this disinflation, which, of course, you've written extensively, is a major burden in our country?
Well, yes, as you know, the economy is in stagflation. And one of the biggest things that you need to do is to try to bring inflation down. I think the Monetary Policy Committee have just been at it for a year. As you can see with the United States, it took them 2 years to be able to bring down inflation on a consistent policy methods. And after 2 years, they were confident enough to begin to cut rates, and now they're holding. So it takes a bit of time. And at the end of the day, it's going to take at least another year before all this happens. So at the end of the day, I think that we're on course. The issues, or I think the cost push factors that have been driving inflation, which primarily has been the fuel price increase, I think we've resolved that. And I think the unfortunate incident of the uncontrolled devaluation of the Naira, free fall of the Naira, also exacerbated the matter. So now that we've resolved the issue of the stability of Naira, and we have stability in the fuel prices, I think the economy has adjusted to that. And this year, we should begin to see the inflation trajectory on a downward trend. Because as you know, a lot of people are complaining about the high interest rates if you're a manufacturer or a borrower. But if you're an investor, you are not complaining about the high interest rates because you are making a good return. So we need to restore some balance once we can control inflation. So I think another year of this orthodoxy should be able to see normalization of interest rates, inflation rates, because as you know, there was a time when inflation was between 9 to 11% in Nigeria, and we need to go back to that. So as of about 5-6 years ago, inflation was at 11% in Nigeria. So there's no reason why we can't go back to those levels of inflation.
Very important, single-digit inflation. And you raised the fundamental issue about the high interest rate. And just recently, Proshare published an op-ed, an article that you co-authored with Mr. Mustafa Chike-Obi, chairman of the Bank Directors Association of Nigeria, looking at the adverse effects of high interest rate spreads on the Nigerian economy. I'd like you to provide some insight into the critical issues raised and, of course, the policy response required. What caught my attention is the fact that in that article, in the past years, between 2023 to 2025, the interest rate spreads for Nigerian banks have on average increased and reached a record high from 6% to 19%. That's a huge, huge one, because it has to do with if you're lending to the real sector or even businesses, that has a huge impact.
Yes, definitely. I think in terms of what it is really is that what has impacted this is the policy coordination challenges that we've seen with this present administration. And the whole essence of the article was to be able to point this out and to understand that while you are trying to resolve inflation, interest rates are high on a temporary basis. And people have to understand that the reason why interest rates are high and why this tightening is to be able to control inflation. That once inflation is under control, things can begin to work. But again, the high interest rate spreads, as you know, are costs that are passed to bank customers. And the fact that we have CRR at about 50%, you find that only half of the deposits are available to the economy for lending and growth. And at the same time, government is also competing with you in that 50%. So the government is already crowding out the private sector. And if the private sector does not have the required capital, it cannot grow the economy. So there are trade-offs that we need to make to be able to achieve economic stability and get the economy out of stagflation into sustained growth and development. So those were just points we wanted to highlight, that policy coordination of trade, investment, industrial, monetary, and fiscal policy are critical for the survival and development of the Nigerian economy.
As you talked about coordination of the policies, you mentioned trade-offs. What are those trade-offs, if you have one or two? The NESG has also raised that issue of the trade-offs.
Well, right now we have to have high interest rates because of inflation. That's a trade-off. Okay, so until inflation comes down to acceptable levels, we cannot begin to cut rates. So you've seen that all over the world. We've missed the global cycle. All the economies globally and most of the economies in the emerging market have been able to deal with the post-COVID inflationary issues. Because don't forget, it was post-COVID that we had these inflationary issues. So they've dealt with that in the last 2 years, and most countries have cut their rates, and their rates are back to what their targets are. But unfortunately, in Nigeria, because of our policies, because of the government deficit, because of the ways and means financing, we find ourselves where we are today. So we have to make those adjustments to be able to return to our low levels of inflation. And we're not saying go back to single-digit 9%. Even 11%, 12% inflation rates will do the Nigerian economy a lot of good.
I know you've also discussed this before about the need to also have a very robust social intervention program. The NESG CEO, Dr. Tilewa Adebajo, recently also agreed, saying that the transmission of this has to be efficient. And from your assessment, Doctor, is it efficient so far? What needs to be rejigged? Because while we're going through this high interest regime, as we want to address inflation, the Nigerian mass need also to have something to breathe off.
Yeah, unfortunately, the social intervention program of this government has failed to take off. And that is what is supposed to provide some sort of succor or relief to the masses. If you don't do that, then you have a problem. We had a minister who was accused of corruption and was suspended, and we've not heard anything from that. And that ministry has not really been rejuvenated, and we're not really aware of these programs. So if they're going on, we're not aware of them, and maybe people are not feeling the impact of some of those programs. So it's just something that we need to relook at, because I think it's important to be able to put a human face, as people say, on your reform program, and also appreciate the fact that you need to provide a cushion for some people, be it temporarily.
Human face to reforms, very, very important. As we wrap up this conversation, what is the monetary policy outlook for year 2025? You've talked about high interest rates, like tightening of monetary policy. Do you see that happen through the year? What other developments would shape monetary policy?
What really drives monetary policy is fiscal spending and fiscal expenditure. And I think what really tends to push monetary policy rates high is inflation. Because even if you cannot provide succor to the people, if you reduce inflation, then you increase purchasing power. Right now, because of inflation, we have become a sachet economy. Everything is sold in sachets because the manufacturers can no longer afford to supply the demand at those sort of high levels, and the middle class has been wiped out. So you find a situation whereby with a sachet economy, even alcohol is sold in sachets. So that's because of inflation. When you can reduce the level of your inflation and you can increase purchasing power, then you now have consumer spending as another factor that can boost economic growth. Because once the households are spending, then you can use it to boost economic growth, because the industry and the firms are doing better because there's demand for their products and services. So these are the things that we need to bear in mind as we go forward, because monetary policy will only react to the environment it finds itself. If it finds itself in a favorable environment, then it will ease. And if it finds itself in an adverse condition, then it will tighten its stance.
Dr. you're well-respected economist in the country and across the region and globally. If you had a 5-minute session with the president, what would the 3 things you would tell him to take on this year that can really move us on the path of stabilization?
They need to cut down fiscal spending. As you know, the deficit has increased. Cumulative deficit for the last 3 years is now 36 trillion. So government needs to cut down its spending significantly. You need to, because right now the government balance sheet is insolvent. Your current liabilities exceed your current assets. So you need to sell down assets, preferably the JV ventures from the oil companies, raise about $30 to $50 billion and use it to restructure your balance sheet, pay your debts down to significant levels, and then so that your international debt rating can go from junk bond status to investment grade, which will reduce the cost of borrowing, and harmonize your borrowing so that, at the end of the day, once you do that, then you can put the economy on a path of growth and then reduce inflation. By doing this, you bring inflation down, and that will create the stimulus for growth. So the key thing that we need to tackle is the government deficit. Government is spending 16.3 trillion on debt service this year. The government revenue is just 35 trillion. So you can see it's close to 45% of revenues of this 2025 budget that is going to go towards debt service. Debt service at 16.3 trillion is greater than the defense, education, infrastructure, and health budgets combined at 14 trillion. So that is not acceptable, and it's not sustainable also.
Very well, Dr. Tilewa. I mean, it's very clear that government needs to cut down its deficit, tackle deficit, and you've talked about the need to turn to assets. We have huge assets. You've talked about our JVs and the other assets that we can turn to. You have that similarities with renowned economists like Dr. Yoteriba. We just hope that government begins to get on board and begin to hit the ground running in this area, and let's see how we take it from there. But thank you very much, Dr. Tilewa Adebajo, an economist and CEO of CFG Advisory, for this very illuminating insights into the monetary policy outlook for 2025 and how that will stabilize our economy. Thank you once again for the time, Doctor. That will be all for this edition of the program. To our viewers, if you want to get further insights on this conversation, visit the Proshare website displayed on the screen and follow our social media platforms to engage further. Until we come your way again, enrich yourself with knowledge of socioeconomic developments around you. It is wise. I'm Otto Basabasekong. Thank you for watching and bye for now.